Good morning. It's Tuesday, the 12th of November, and this is Govindraj Ethiraj, usually headquartered in broadcasting as well as streaming from Mumbai, India's financial capital, but now in transit. The take, location is becoming history. Time was when success in business meant making a great product and then selling it at a price that obviously helped recover all the costs that went into making that product, including the advertising, marketing, and distribution, and of course, with profits on the table. Now, in the last few decades, profitability has not been so much about where and how you sell a product in general, of course, but where you produce it. Older Indian manufacturing companies are used to this, by the way, having moved production between and to locations across states, hunting for tax incentives. Locations like Silvassa in the Union Territory of Dadra and Nagar Haveli adjoining Gujarat, Pantnagar in Himachal Pradesh, and even Haridwar in Uttarakhand. In the early 2000s, new industrial units set up in these areas could be entitled to a 100% corporate tax exemption for 5 years and then lower taxes for the next 5. In addition, they got a 100% excise duty exemption for 10 years from the date of start. Now, the excise duty part is subsumed into the goods and services tax as of 2017, and tax holidays are over. Nevertheless, all these places still enjoy the benefits of industrialization and job creation, even if they're not the logistically best positioned in national or global supply chains, particularly some of the more remote manufacturing locations. But if location shopping was earlier confined to within India, it's also gone global. India's garments industry is a good example. For almost 20 years has been moving production to Bangladesh, with most major exporters hosting factories there, making garments from cotton and yarn, often imported from India. One report in Outlook Business says 25% of manufacturing units in Bangladesh are owned by Indian companies like Shahi Exports, House of Pearl Fashions, and Gokuldas Images. Indian companies have, of course, been importing directly from China and, in many cases, badging products here. White goods like air conditioners or even toasters and electric irons are a classic example where products might be made in China but sold in India under a local brand. So the election of Donald Trump as President of the United States and the real possibility of high tariffs ranging from 20 to 60% on imports into the United States is putting manufacturers world over in a quandary. Firms who are making in China are bracing for the worst. Shoe brand Steve Madden has said it will reduce goods manufactured in China by 40% within the next year, up from its prior target of a 10% reduction. As of yesterday morning, we are putting that plan into action, its CEO told analysts on an earnings call on Thursday, as reported by Bloomberg. Whirlpool, which makes Maytag and Amana household appliances, says Americans will see higher prices on microwaves if tariffs are increased. A top official told Bloomberg that the biggest thing they get out of China is microwaves, and that they would be more insulated from the risk than other manufacturers because it produces most of its goods sold in the United States domestically. Steve Madden says just under half of its current business would be potentially subject to tariffs on Chinese imports. If the company's plan to mitigate its exposure is successful, that would drop to around 25% within the next year. And that is because, like many other countries and companies, Steve Madden too has been shifting its supply chain more towards Cambodia, Vietnam, Mexico, and other countries. Some years ago, Steve Madden imported 95% from China. Indian manufacturers are possibly better off staying at home and trying to produce more efficiently and hoping that India will face a lower band of tariffs if it does. India could face a 20% tariff ban, whereas China is looking at 60%. Now, this is, of course, all the campaign promise. India could also hope that bilateral negotiations could lead to some compromise. But for manufacturers and producers, the larger lesson is that location as a strategy to manage costs is now receding into history. Even if the US relents on tariffs, the uncertainty on tariffs and linked to geopolitics will stay and most likely increase. Remember, tariffs on Chinese products have already gone up in the last few years into the United States. So companies have no choice but to produce closer to their consuming market. Now, it's not that they do not or have not realized this already. What they do realize is that producing in relatively higher cost countries like India, even if closer to the market, will push prices higher, whether it is for the intermediate or final product. And that is a problem that we have to solve at some point. And that also brings us to the top stories and themes for the day. The stock markets are flat even as mutual funds see record inflows from investors. Will India depreciate the rupee? SIPs of mutual funds cross 25,000 crores a month as long-term investors stay plugged in. And a full-service monopoly takes over India's airways. Vistara signs off and becomes Air India.
This is the Core Report with Govindraj Ethiraj.
The markets stay flat. The Sensex moved between 79 and 80,000 on Monday and finally ended flat. The closed at about 79,496, up just 9.8 points or 10 points from its previous close, while the NSE Nifty 50 was down about 7 points at 24,141. The broader markets were in the red too, with the Nifty Small Cap 100 and the Nifty Mid Cap 100 falling about 1% each. The overall attraction of India for foreign institutional investors in the shorter term is still mixed thanks to comparative valuations. The MSCI India Index, which covers about 85% of India's equity assets, trades at an average 12-month forward price-to-earnings ratio of 22.8. That's above the price-to-earnings ratio of about 12 for MSCI's emerging market stocks, Reuters pointed out. Also quoting analysts who said that they were cautious on Indian equities but bullish on the country's sovereign bonds and found the rupee to be an appealing carry trade currency. The reason for that is the Reserve Bank's forex policy of stabilization, making the rupee one of the best risk-adjusted carry trades, analysts said, and more on that shortly. Will India depreciate the rupee? The rupee fell to an all-time low on Monday again, as most currencies in the region continue to be under pressure from a strong dollar. The Reserve Bank's interventions prevented more losses, Reuters quoted traders saying. The currency ended at about 84 rupees 39 paise, below its previous low of 84 rupees 38 paise, and was down partially or rather marginally for the day. Meanwhile, Bloomberg is reporting in a somewhat dramatic source-based story that India's central bank, that's the Reserve Bank, is ready to let the rupee weaken in tandem with the Chinese yuan after Trump's election win spurred fears of higher US tariffs. So a depreciating yuan will lower the cost of Chinese goods, potentially leading to more imports and further widening India's biggest trade deficit with any country. So the Reserve Bank of India is apparently poised to cushion that blow by allowing a weaker rupee, even while using its ample reserves to keep the fall in check, according to people who spoke to Bloomberg. On the other hand, analysts have already started revising the rupee forecast, as we've seen in our conversations at the Core Report as well. The rupee could breach 85 rupees to a dollar within 12 months, according to HDFC, while IDFC First Bank sees it hitting 84 rupees 50 paise much before its earlier projection of March, says Reuters. Despite all of this, the rupee, as has been pointed out on several occasions, is one of the least volatile currencies in the world, with the Reserve Bank of India using its about $680 billion foreign exchange reserves to manage the rupee's sharp swings. On the other hand, that foreign exchange reserve pile has also been diminishing now for the fifth straight week. There's a mutual fund bonanza. The markets may be taking a breather of sorts, but equity mutual funds are seeing record inflows, and possibly that's a good sign since it suggests longer-term investors are still plugged in. Funds coming in through the systematic investment plan route stood at about 25,300 crores in October, an all-time high against the 24,500 crores in September. So the number of systematic investment plan accounts are now at about 101 million in October 24, as against 98 million in September. Overall, equity mutual funds saw about 42,000 crores in October, which was up about 21% month on month. Data from the Association of Mutual Funds of India showed in a Business Standard reports. This also marks the 44th consecutive month of net inflow in the equity-oriented funds, and that obviously demonstrates the increasing or steadily increasing appeal of mutual funds amongst investors. From paints to steel, companies under pressure. Here's some corporate news with two companies, and let's start with the first one. That's Asian Paints, whose stock fell the most in over 4 years on Monday, as price cuts across its products and floods in some parts slowed down second quarter sales volumes and also brought it below analyst estimates, according to Reuters. The stock fell about 9% on Monday and was set for its worst day since March 2020. Asian Paints is India's largest paint maker by market share and has previously indicated weak demand for its premium products as shoppers chose cheaper alternatives. The paints industry's latest big player is from Grasim Industries of the Birla Group with its brand Opus. A volume slowdown, market share loss, and a faster than expected scale up for these newer entrants are some of the risks for Asian Paints, according to analysts at Morgan Stanley. Its profit nearly halved to about 695 crore rupees in the 3 months ended September 30th, as opposed to analyst estimates of about 1,000 crore rupees, according to LSEG data quoted by Reuters. In other corporate news, Tata Steel's top brass told Business Standard that weak market conditions were making it tough for them to say when they would be out of the woods and thus could not project at this point when they could start investing in fresh capacity. According to them, the low point for steel prices was about $450 per ton in August internationally, and that was now at about $500 per ton. The hope also was that if the Chinese stimulus works, then exports would drop. That's exports out of China, which could thus push up prices. Tata Steel's brass said that this was the worst phase that they were currently facing. It's goodbye to Vistara. Yesterday, November 11th, was the last day for Vistara Airlines, which has, as of today, merged into Air India and becomes the only full-service carrier in India and thus a monopoly. Vistara, launched a decade ago by Tata and Singapore Airlines, managed to position itself as a premium product, particularly for business and frequent flyers, also replacing the now liquidated Jet Airways. The merger became inevitable in 2022 after the Tata Group acquired Air India from the government. Singapore Airlines held a 49% stake in Vistara earlier, and now it will own 25% of Air India, the combined entity, following this merger. Following strong passenger feedback, the Tatas said that they would and are showing the distinction between Vistara and Air India for a little longer. Passengers can identify Vistara flights by using the 4-digit numbers for flights beginning with the number 2. For example, a Vistara flight UK 944 will now become AI 2944. This arrangement is expected to continue till June next year, at which point the upgrade efforts in Air India should lead to a largely synchronized product across the merged entity. Air India is spending about $400 million as per reports on a retrofit program for its legacy narrow-body fleet. I spoke with Ajay, Awtaney, editor of Live from a Lounge, and I asked him about what he saw ahead, including his memories of Vistara, and finally, whether there were any cautionary notes as a full-service monopoly kicked in. More significantly or interestingly, I caught up with him just before he was going to board Vistara's last domestic flight, that's UK 986, from Mumbai to Delhi at 10:50 p.m. last night.
One of the major changes that we will see as this is playing out is that there will be no Vistara existing anymore. Entire operations, all the planes, all the employees, everything that was touched by Vistara ever will be subsumed into Air India. The flights, while they will still be operating by aircraft which are branded Vistara, they will carry, for example, sticker which says operated by Air India. I don't know if they'll be able to do this overnight or not, but in a few days you start seeing stickers saying operated by Air India. The flight numbers change to AI flight numbers from Vistara flight numbers. And yeah, the customer care, the helpline, the loyalty program, everything changes and transitions to Air India. Those are some of the customer-facing things that will change in terms of the migration of Vistara and it being subsumed into Air India.
Right. And you have a lot of memories, Ajay, from the first flight, since you're also boarding the last flight. So tell us about some of them.
So yeah, I've just been never thought that I'd get so deeply involved with the airline, but I've always considered myself to be a full service airline person. And Jet Airways was my favorite airline. And incredibly lucky to have seen a new full service carrier born in front of my eyes. So, I got on the first prize in 2015 without any hopes at all. But, here we are 9 years and whatever, 7 months later, getting ready to board the last flight of the same airline. So it's been an interesting journey along the way. I think I've seen quite a few of the very interesting, memorable milestones. For example, this has been an airline which has been very focused on passenger experience. So I got the opportunity to fly over to Airbus, I think back in 2017, to step out their first A320neo aircraft before it was delivered to the airline. And then they've been very focused on doing things that are experiential for the customers and, connect them to the legacy of the JRD Tata. So they organize, I'm sure you would have seen them all as well. They got one aircraft painted as, Tata CI9. It still is a unique aircraft which kind of can be seen across the country, flying around all over the place. So back in the day, they used to do experiential flights where they used to do things with, or like so JRD Tata most preferred food and so on the plane. So those have been some of the things I've happened to see. And now here we are on our own initiative again, trying to make it back to Delhi on the last flight of the airline.
Ajay, you talked about full service, and now this will become the only full service airline at this point until maybe Indigo ramps up its business class, which it's also launched. But what are the concerns? This is effectively a monopoly now, so which also brings with it some concerns, some cautions. What would you say to that?
I think business models as we knew it maybe 5-10 years back, business models for airlines continue to evolve. Okay. So for example, Vistara was a full service airline, but it had 10 aircraft which were only flying in, a single cabin configuration. Air India had about 20 aircraft, has 20 aircraft, which are flying in a single cabin configuration as well. So I think there's no right or wrong definition of full service. I think the differentiation has been that, does it have, let's say, a business class cabin? Does it serve a meal? And those are some of the, does it have a loyalty program? And those kind of things kind of, differentiate a full service carrier from a low cost or no frills carrier, as I like to call them. So I think Indigo is kind of very much on its way into that segment. They launched a loyalty program, and about just later this week, they will be launching their Indigo Stretch product, which they insist is not a business class product, but it's a direct take on, trying to provide low cost business class product. But yeah, I think yes, Air India will be a monopoly, but Indigo is kind of, tiptoeing, at least on the domestic route right now, to challenge that monopoly right as the merger process.
And I guess that's a good sign because, you need competition of some sort in the marketplace. Finally, Ajay, as you look ahead and as you look back, we saw what happened to Jet Airways. The airline was liquidated just last week by the Supreme Court. Any one lesson you think airlines should always keep in mind, even as they try and keep customers happy and also have an aggressive presence in the market?
I think making money is the most important lesson they need to keep in mind. Jet, Kingfisher, SpiceJet keeps coming back from the sordid death. I don't know how. But all of these airlines, like about 5 years back, we were really selling, let's say, Bombay Delhi ticket at 3,500 or 4,000 rupees as well, which was not the fair price of the product. It was maybe not even covering the cost of the fuel that was burnt on a per passenger basis. So I think now airfare is sort of in the zone where it's perhaps a fair price. I don't know if it's for the good price or the bad price, but it's a fair price to cover the costs. And airlines really need to implement, pricing discipline. They can't be selling, let's say, a Bombay Delhi flight again at 3,500 rupees anytime in the next decade, because now people have kind of gotten used to air travel, even people down, not the top strata of the society, but the middle class and so on, and look at it as a time saver compared to a train. And those are the things that really spin air travel into growth mode. So I hope they're not going to make some of those foolish things that happened over the last decade. And we've seen already so many airlines die the last decade. And now with the duopoly, prices will be high. The customers will be biting the lip every time they pay for it. But hey, they will still fly.
Ajay, thank you so much for joining me and have a safe flight.
Thank you.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.